Hello, I'm Greg Vanel. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights, help boost your trading potential. Coming up, investors treading cautiously, concerns over the health of the U.S. economy taking center stage. That follows the OECD's downward revision to U.S. growth and the outlook there, just expecting 1.6% growth for this year now. Of course, it goes back to trade tensions, rising policy uncertainty. Plus, oil prices on the rise again this morning, driven by strong demand and continued supply disruptions. That's despite OPEC still boosting production. We're going to take a closer look at the technical factors underpinning this latest rally and our trading debaters standing by the bull and bear cases for Dollar Tree as it navigates a challenging retail landscape. That's all ahead. You're watching TD Active Trader Live. We're into the month of June when it comes to trading. It has been a cautious beginning to the month. We have some very modest green on the screen right now for the S&P 500. Nothing overwhelming, but investors are trying to figure out which direction is this market going to head. Of course, we've had China and U.S. ramping up the trade tensions over the last several days. If you look back in the month of May, well, this is a one-day chart, but very, very strong rally. Take my word for it for the month of May. Of course, that was after the April sell-off. It has been a bouncy ride. The big question for June becomes what comes next. And hey, you just got to keep following social media, I guess, to figure that one out. Let's take a look at the heat map and see what is moving right now. There's push and pull that has us modestly positive in the S&P 500, just on the break-even line. NVIDIA getting a bit of a bid today. Same with Broadcom, so the chip makers. Some of the other tech names not showing us all that much. So yeah, it's a bit of a mixed board there, right? For all those that are modestly higher, there's some that are modestly lower, just sort of holding us at that break-even line. Let's get into some of the specifics. We're going to debate Dollar Tree later in the show. Dollar General out with its latest earnings, raising the annual sales forecast. Investors seem to like it. The stock's getting a pop today. It also topped estimates for its most recent quarter. It is addressing the tariffs, because of course you think dollar store, you think goods from China. They say they can mitigate most of the impact of the cost of goods from these levies. And, inflation's still high. Tariffs, got economic uncertainty out there. Apparently, consumers were driven to this dollar store in particular. Don't want to put my thumb on the scale for the debate that is to come, but Dollar General today getting a bid off of all of this news. I want to talk about why Facebook, Facebook, catching up with old high school friends and all that kind of stuff, needs nuclear energy. Constellation Energy shares getting a pop today. This is Meta, the parent company of Facebook, signing a 20-year agreement to buy nuclear power from Constellation Energy. Probably not so much about your cat photos as it is about artificial intelligence. All the big tech names want to be in the space. They know that AI is hungry for power. They're all signing nuclear deals. Remember, it was just last fall that we got Constellation saying it was going to restart the 3 Mile Island. This is because Microsoft has a 20-year agreement to buy nuclear power for them as well. And that's your market update. All right, joining us now for a more technical take on what's happening in the markets is Here in Amin, Jason Natick from our TD Direct Investing Education team. Gentlemen, welcome back for another week.
Great to be here. Great to be back again, Greg.
All right, so what do we got going on? We always got lots going on. As I said, we've hit the month of June now. We had a nice rally in May, a tumultuous April. You're looking at the QQQs to start.
We're looking at the technology sector again, yeah. So triple Qs is what I have up here. It's the technology sector, of course, tracking the NASDAQ 100 companies there. As you mentioned, May was probably one of the best Mays in decades for a lot of these indices, namely the SPX, but also the triple Qs as well. The NASDAQ 100 rallied about 9.04%, just a little shy of the SPX and what they notched. Best May on record since 27 years. So back in 1997 was this when this happened, and it's typically defied the old adage that's on Wall Street, sell in May and go away. Right? Yeah. Exactly. So now what we're also seeing is with the triple Qs on May 19th, they kind of peeled back to just see what the ETF flows were like. It saw like almost $4.6 billion on one-day flows on May 19th, which is the third largest since its inception in terms of the cluster. So it really shows you how much momentum, institutional activity is really taking place and buying up this rally coming into it. But then also the administration, the weekend, obviously topsy-turvy news. But what's evident is coming out of all this uncertainty, investors have taken notice of the fact that most of these sort of stringent tariff threats have either been ameliorated postponed or both, in both cases. And a lot of the bad news on the tariff front is no longer being perceived as truly a threat. And if you want to call it the half-life of this each negative piece of tariff news, it's getting shorter and shorter by the day. There you go. All right. So let's look at the charts. Let's see what's pulling up here. So I've got the charts pulled up on the Qs. We saw this big swing low coming out of April and going to May. We saw this big rally coming up. This yellow perforated line I have, this is a 2-year bullish uptrend. I'm just going to zoom out a little bit and you can see it's resumed back up. It had the breakout above it. It's now firmly kind of, that's what's acting as the dynamic resistance sort of support at this point. It is running into some resistance. This 525 level is now the new resistance. It rejected off of just a couple of days ago on this big bearish candle coming into it. But this is going to be the test. If it pushes above the 525, we could see then hover the 540 level, which is the highs that it has hit all time. But I'm going to be a little cautious because you can see I have these two little circles that I plot up in the graph, and these are the gap levels. And we tend to know in technicals that gaps tend to get filled. We don't know how long it's going to take to get filled, but these are levels to also keep an eye out on. If we do get them filled, we're looking down just below the 500 level, the 495 mark, and even further down to that is the 475. If we do see a reversal, it could come through these support levels as well. Right now, RSI is kind of in that sort of overbought region. It hasn't reversed back, so it's still holding in place. What I'm going to be curious is just to make sure that trend still holds in there. But we are seeing the MACD histograms getting a little bit shallower, so want to just keep an eye out on just in the coming months there how it shakes out.
Right, heading into the weekend, we had the core members of OPEC meeting. There was concerns about them boosting production even greater.
Yeah.
When that didn't come to pass, crude is rallying. What are the technicals telling you?
Yeah, so let's look at crude. So that was the news, right, Greg? The OPEC Plus, they increased, is a third production increase that they're going from. This is a lot of it was they did those big cuts in 2024. 411,000 is the increase that they're going to go for July. So May, June, July is what they've committed to. We saw crude futures being bid up to the tune of about $63 a barrel, 63 and change. That's currently where it's sitting at right now. If I pull up the chart, you can see it's forming this sort of bullish reversal pattern that we have going on now. By and large, crude's been on an overall longer-term bearish downtrend over here. We can see it hasn't even touched it until like early 2025. So we're still a ways to go away from that level. The 70 level is kind of where that is. But at the moment, you can see we've got this inverse head and shoulders pattern that is not completely formed yet, but it's on its way to forming. We can see as long as it respects this final sort of right shoulder that's forming over here, then we could see it kind of going towards that $65 resistance zone. Now, a lot of this production, you can understand the increase in production is also there to really put pressure on a group of rivals, which are the U.S. shale producers in the U.S. So we'll see what comes out of that. We know demand is, they've posed that demand is strong. It's getting stronger again. But again, the South Asian countries do remain weak. So that would see if it does hit that 65 and reverses off of that. So that's what we're looking at. If it does go, we could see it push back closer to that 70 level and kind of get back into that channel that we want to check at.
So that's crude oil. SLX, what's this?
We got one more, Greg.
Yeah, what's SLX? So no, that's not you. That's you. You're TLT.
I'm TLT. We've got to look at the bonds before we get to SLX. Yeah, so we're looking at TLT. It's the iShares 20+ year Treasury bond. So it's basically a basket of any bonds with a 20 years or more maturity on it. Bonds have been a big fixed staple. They've had volatile, especially the longer duration ones had a volatile period over the last couple of months there. One of the big things is around this is the Sell America idea, that fad with bonds and the US dollar dropping while gold is rallying, that's still kind of in play. We can see with the TLT chart that I pulled up, it's been on this long sort of downtrend. I can't even peel back far enough, but it's kind of fallen from grace from where it used to be, those highs there. You can see back in September it was at the 101 level. We're kind of teetering just closer to this. It just bounced off of this 83 price level, which marks a 16-year low for TLT over here. But the big news about this is when you look at the spreads as well, we had the downgrade that happened in May. May 16, Moody's was the final credit firm to downgrade the U.S. debt to AA1. AA1, I should say. But also what you're also noticing on the yield curve, the 2 and 20 yield spread is widening to about 100 basis points, which does suggest there's a higher term premium embedded in the current yields there as well. This is one to keep an eye on because it is more sensitive, and longer duration bonds are typically going to be more sensitive to interest rate movements than the shorter term ones. So just to see what the rest of the news unfolds. We are going to see if we can break through this moving averages. The moving averages sloping down, but if we can break through this sort of bearish wedge, we could see kind of tickle up. But that's again, if we're seeing the interest rates cuts happening, which is projected to happen, but possibly in July right now, the higher impetus is in September, then we could see further pressure being put on TLT and the longer term bonds there for us. So want to keep a close check on.
With the US buck now at 3-year lows as well. So lots of interesting stuff happening in the space. Someone tells me you want to talk about SLX.
Yeah, there's a rumor.
I don't know where I got that. There's a rumor floating around.
You gave everyone at home time to bring it up on their own
Moment
charts.
to digest.
We can play along together, for sure. So in case Hiran alluded to it, in case you missed it, if you're maybe living under a rock, some news out of the U.S. administration about talking about increasing steel and aluminum tariffs up from 25% up to 50%, with U.S. domestic steel producing roughly 70% of what's used in the economy. There's still a big gap, and Canada is the biggest importer of steel, making up about 25% of that. So there's a big a lot of very contentious issue here as well. So yeah, we are looking at SLX. This is a non-diversified fund that tracks the NYSE ARCA Steel Index, and is actually something that makes up. It's not just U.S. focus. It's 58% U.S. companies, and it's got some international exposure to the tune of just under 42%. All right, so with tariffs rolling out, U.S. steel prices with the initial 25%, over that time period, they saw domestic prices actually go up by 16%. So there was just a natural increase of prices along with international. So that'd be interesting to see how that's going to play out over with the new. And if we're thinking about sensitivity to steel prices, my mind automatically goes to automakers, right? And this is something that came out.
Saw that yesterday, and Ford and GM.
Ford came out and said revenues. They're saying could see a sharp drop, $2.5 billion, pullback in revenues, leading to additional price increases, and they're already starting to warn about job cuts. So, but let's take a look at the chart for SLX so we can see a bit of a picture, a little tail of the tape here. So we saw, coming in towards the election time, towards the end of the year, big sell-offs. You alluded to it with oil as well, but the same is holding true from a steel perspective. China, there's concerns about struggling demand for the products, and as well there's a lot of uncertainty around how those tariffs are going to play out. But there was certainly some recoveries that happened in the new year. But we saw kind of a classic double top pattern forming in through February and through March, and we did see that pullback play out, kind of really timed right around those reciprocal tariffs. But we did see a bounce back in prices right around when kind of the reciprocal tariffs were pulled off. The stock the ETF rather is pulled right back into kind of its kind of zone that it's played into. Outside of the last couple of days of pullbacks, you can see there's some big red candles. If I zoom in on the chart, some big red candles the last couple of days. We're looking like we're crossing over the 200-day average. That might be a little ways off in the future because even though domestic suppliers have really seen bid ups in their price, we're talking CLF, we're talking like Nucor and X. But international suppliers have maybe come down a little bit in price. So that's kind of weighing on this fund specifically, but still want to keep an eye on going forward.
All right, fascinating stuff, and we're just getting started. Thanks for that, guys. If you at home have a question for our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website. Once you're there, you're going to find more information about all of our trading platforms under that Get Started tab. So you can find the one that is best suited for you. And if you're interested in trying out the TD Active Trader platform risk-free, you can open a practice account. Just click on the Try TD Active Trader button. All right, time now for the main event. Trading, debating this week. The stock in the spotlight is Dollar Tree. Before we get going with our debate, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. All right, let's get back to the stock of the hour, Dollar Tree. What made you guys pick this one to debate? Alicia told you.
Our producer told us.
I know.
Crack the whip on us.
We thought deeply on this. I'm in big trouble after the show.
No, but as you mentioned, Greg, right? It's the inflation environment and shoppers possibly trading down. And kind of one of I was mentioning this. One of my big pet peeves with our local domestic dollar store, Dollarama, is that it kind of is deceiving. You think that you're going to go in for $1, but most of those price points are like in that $3 to $5 range, maybe a little bit higher. While as Dollar Tree is in fact true to its sort of brand and banner, like getting
More
priced
true.
in closer, more so at the $1.50 in Canada, I guess, but $1.25 now in the US. So it's one to look at and just see what those trends are with their shoppers and the foot traffic coming through those doors.
Yeah, and they've actually got a couple interesting corporate milestones coming up. They just opened their 9,000th location, making it the 4th largest retailer by locations, behind Dollar General, who you spoke about, 7-Eleven and CVS. And next year's their 40th anniversary. So
look at those.
Great for them. So.
Okay, and I go into the dollar stores to get the greeting cards because I'm not paying $11 for a greeting card anymore.
Yeah.
That ruse is over. So we had a lot of positive things to say. There's got to be a bull, but there's got to be a bear too. Let's get some time on the clock. You usually have 2.5 minutes to make your case, and then we're going to get you some time to counter. You draw from a hat as always. Jason, you are the bull. Why don't you kick things off?
I'm the bull. I figured we were coming to me this week first. So let's get started. So when does taking a nearly $7.5 billion haircut actually work in your favor? Not often, right? But this might be bucking the trend, and the exception might be here with Dollar Tree. And they had a long-awaited divestiture where they had a purchase about 10, 15 years ago of the Family Dollar. Well, guess what? It was not as focused on their key business metrics. And they've recently just divested it off for the paltry sum of $1 billion to a private equity firm. This allows a Dollar Tree to once again to streamline businesses, move away from more direct competition with some of the bigger box players and focus on their core business, which is seemingly resonating. And maybe to Hiren's point, you've got customers that are loving the hunt of seeing what they're going to be able to find in the store, but also, with a tight economy, it's playing right in their budget. And their shares rose nearly 6% on the announcement late in March, and have been on a run. It's been quite impressive since. Now, outside of the economy being tough, which is now just organically pushing shoppers. And there's a couple things that kind of stand out to me. One is they've just recently had a big turnover with their longtime CEO has stepped aside, and we've got retail industry veteran Michael Creedon Jr. Make sure I get his name right. The stock was on a 60% sell-off in terms of under the previous administration, if we want to call it that, but there's been an immediate bounce. 3% on the negative announcement, 30% since the start of the year. But the next thing I want to mention here is, the company is still committed to keeping prices low, even with tariffs abound, around that $1.25 price point. But they're also actually rolling out, much to your chagrin, a strategy to bring in a $3 to $5 range. That's going. And we actually introduced some frozen goods into the lineup. And they've actually, on those stores they've converted, they've seen outsized sales with an increase of about 4.6%. They've got plans to convert another 5,000 stores by the end of the year. But let's jump into the chart so we can see exactly what we're talking about here. I want to focus more on the recent term here. What I've been able to kind of notice here after we've seen the increase over the last, really it's been the last number of months, as I said, after the new CEO, we've seen an uptick in prices over that time. It's been included with the CEO departure as well as the Family Dollar store sale. The stock has been on quite a run here. We had a gap down on the last earnings. We've now been able to approach that gap. There's been some bullish signs looking for confirmation across the market. We've seen the price cross the moving average. We've seen the triple moving average cross just ever so recently. And I'd be remiss to say there's one pattern I know it's one of Hiren's favorites that I wanted to kind of bring up and show here. We've got a recent cup and handle that's been able to develop that's showing us we've had a near-term bull kind of show pull back, but are leading potentially back towards near highs.
I'll give you a ring.
Hit that one hard, all right. A little harder than I should have. The bear. What's the bear got to say about all this?
All right. You make a compelling argument, Jay, but I'm going to say that, Dollar Tree's woes are not behind it by any means, right? They're facing mounting headwinds in terms of operational, competitive, macroeconomic fronts. So despite short-term technical recoveries, which you eloquently put together there, they have structural challenges in their business model, weakening consumer demand and strategic missteps that they've done. Let's talk about the anticipated earnings, because that's what everyone's going to clue in for coming into this. On the EPS side, they had a significant loss in the previous quarter. This quarter coming into it, they're not expecting to bounce back from that by any means. Revenues projected to come in $4.54 billion. That's negative 40% down year over year from where they were before. But also, they have, if you look at the balance sheet, their selling and general administrative expenses have been ballooning. And that's going to cause compression across the board on the top line and their bottom line. The Family Dollar the way you put it is what I'm going to describe as blunder. So the $9 billion blunder, which is about an $8 billion loss, they're coming out with $1 billion, but in fact, there's going to have about $200 million or so in costs. So really, it's about $800 million or so is what they're walking away with. That was just management's like misstep in sort of overexpansion, not being able to really put in the sort of management that they needed to. And then we're talking about tariffs and kind of a weakening consumer sort of footprint. 40% of Dollar Tree's goods are manufactured in China, of course. And we know they're sensitive to the price points that they have. This is a company that makes like 2 or 3% margin on their goods. So that's going to be weighing on them heavily. Coming to the charts, I'm going to look at the monthly chart is where I'm going to start with, just to show you kind of where it's swung up from. So it's hit this, it has this 120 resistance is kind of where it is. It's swung down from these lows. It's kind of hitting this $90 resistance, and that's where we should see a reversal with this weakening candle. We're seeing sort of volume also ticker down. I'm just going to switch over to my daily chart just for a second here, just to show kind of the trend and where we're going to be running into things over here. The other thing that I also want to look at on the technical side of things, yes, sure, we did have a gap up move today because in sympathy trade with Dollar General, but it is a weak sort of doji candle. But the bigger thing for me is the issue with the volume. Big declining volume. We've got very small bodied candles that are forming in here. And also we see this very shallow MACD histograms that are forming over here. Although it's still in the positive territory, this is kind of that resistance area where we do see a reversal, but it's also a gap area that it wanted to fill going back over here, and we should see a reversal coming through today.
All right. Strong arguments from the bulls, strong arguments from the bear. It's time to get into it, boys. 3 minutes to go after each other.
All right, let's do it. So I wanted to speak to tariffs. You brought it up so nicely there, but it's true. 40% of their products do come from overseas, but they've actually got some really interesting experience in different ways to kind of help them head this off. So it's not just Dollar Tree that's going to be raising prices. They've got essentially cover from around the retail sector, and then we're thinking about smaller prices. We're talking percentages, as smaller increases that are going to allow that to be much more palatable to their customers. But here's one of the things that I thought was really interesting in some of the research is they've got experience here. They've got bring a lot of shipping. They've had concerns with rail and other shipping contracts, bringing products to them. They've been able to manage these headwinds and still continue to demonstrate their ability to keep inventory on the shelves and to keep their prices low. And then lastly, what's really neat about this, it's a years-long process. They've been offering an opportunity to they're called private label brands. So these are kind of like national brand equivalents. They came up with 125 of them last year, with more in the hopper. So they've got strategies to weather these events that are happening internationally here in America.
You know what, actually, to that point that you just mentioned, supply chain has been one of their Achilles heel, in fact, and they haven't been able to get a control of it. It's been spiraling the costs. We talked about Dollar General. Let me talk about the competitor, which is their biggest competitor right now. They have a 20,000 store footprint. When you look at the retail space, one of the measures that you want to look at is square footage, sales per square footage. So here's a comparison for you. Dollar Tree sits at about $232 for 2025, the year ended, right? It was below what they did in 2024, which is $234, but they increased the square footage also by almost like to the tune of about 6 million there. So they had a new storefronts. Dollar General, by that same token, does $259 sales per square footage, okay? So in that significance. Now, that means, like, they obviously have, branding power, but also the other thing is, my big issue with the dollar business in general is the competitive beyond just the dollar stores. It's Walmart and those other likes. They don't have really undifferentiated goods, and the shopping experience we talked about, which is suboptimal when you go to these stores. So why would we talk about trading down, but if you're getting values into the $3 and $5 price points, which you put, why not just go to like a Walmart or like a Target or whatever wholesaler that you have, then rather than coming over here. And then the other thing that we should also mention is another ratio on the fundamentals that you want to look at is day sales inventory. Again, I'm going to take a direct jab at Dollar Tree because it tells you how many times do they clear the inventory on a cyclical basis. So Dollar Tree does 133 days. And Dollar General does it in 88 days.
Let's leave you with one final thought here. We're following the smart money. Institutional holders is actually increasing, so it went from 64 to 67%. And actually, institutional holdings is actually over 100% of the float. It might sound a little kind of irrational, but we're talking about short sales and reporting timeframes. And then lastly, as well, taking that money that they've received from the family dollar, they've invested back in themselves with big share buybacks. So they're seeing values taking bets on themselves for the future.
Nice work. I don't know what to say. Well, that's a good point, Jason. Well, that's a good point Heron's making. No, that's a good point Jay making too. I guess that's the nature of the debate. Now, if you were the bull and you wanted to play it through an option strategy, take us through the platform. Show us one.
Yeah, absolutely. So I'm going to talk to us about a strategy that's typically for like a range-bound trade, but we can still have a bit of a bullish lean to it. So I want to bring us into the chart so I can help kind of talk us through. I'm switching myself to the hourly chart. Let me move back out to the daily. So the trade that I've kind of identified here, this potential would be for what's called an iron condor. An iron condor is where we're looking to sell a higher value call spread and selling a lower put spread. So we want the stock to expire in between those numbers, so we can see. Oh, there we go. Let's get those labels on the chart. So effectively, I make max profit if I can have the stock expire within the range. I put on the chart the probabilities of those zones because we want to make sure the math is working in our favor. We want this to expire worthless. So if we can have out through July is kind of the time frame that we've identified, that could be potentially. It's one of those things when you're selling options, you want to manage time. You want to sell enough time to get enough premium back in, but you don't want to sell too much time that you've got time to work against. And just as we've kind of highlighted through the conversation here today, there's always weekly, daily, monthly uncertainty that we just don't want to allow too much time that news can get ahead of us. So in this particular case, I've identified the opportunity to sell. Let's bring up the trade from the bottom of the screen. If we can sell a put spread with a short strike of 85 and a long strike of 75, so we have a $10 width on that, and then we can go ahead and reverse the trade on the call side, selling a 105 and buying the 115. If you are feeling exceptionally bullish, there's a couple ways that you could amend this strategy to either get additional premium in or to widen out the spread. You could always take the call side, move it up a little bit higher. You could widen out the spread beyond $10 so you're taking in a little bit of premium. But there's also a strategy called a Jade Lizard that you can amend this even further. And that's where we're still going to keep the call spread on to give us protection on the top side. But you can actually remove the long side of the put spread so that you're only just selling essentially a naked put on the bottom side. So you've got exposure to the bottom side, but you are taking in a bit of additional premium. So the goal is here to kind of get some sideways consolidation continuing in its zone, but not have too drastic of movements.
And of course, the risk here is that you don't get that stock staying in that band.
It would be, but that's the whole benefit of the iron condors because they're two credit spreads. Which, in this case, we've taken $10 wide spreads. Our losses are $10 less the premium, and that also brings us back to the benefit of the iron condor. You're taking credit on both sides, reducing that $10 spread. So it's got that working in its favor.
I love these terms too. They sound like old action movies. The Iron Condor, Episode 4, the Jade Lizard.
I like it.
From the bull.
From the bear.
From the bear. What would a bear say? No, I'm going to do two bulls. I'm just completely throwing out the rules. Two bulls now. What would the bear do?
All right. So the way that I looked at it, Greg, was I looked at a couple of stats just to see positioning into earnings coming up. One of the things that they have is, the put-call ratio is one of the measures that we look at, just bringing up the chart, just to see where we're seeing the sentiment in terms of posturing now. Before today, in fact, they were kind of sitting in that 1.5 region. They've chopped it in half today, so that means there's a little bit of a balance. There's more sway on the call side of things right now. But the other thing to also look at coming into earnings is the volatility. We haven't seen volatility move up significantly compared to where it has been in the past. It's kind of sitting in that 40%, which makes me think that, which means typically that your option premiums are going to be of more value. They're not going to be priced in with a lot more extra volatility. So the trade that I'll be looking to do is what we call a diagonal. It's going to be called a diagonal put spread. So essentially what I'm going to be doing is trying to, still bearish, so I'm going to be selling a $90 put contract, but I'm going to go further out to July. So we're going further out in expiry, but selling the front month $80 put to just cover it, okay? So what this trade does essentially is I want to take advantage of whatever sort of volatility that is left coming into earnings, capture that, and then I can roll that 80 strike over until I get to my expiry of the 90. But the idea is essentially we do want a downward movement to happen, just not going beyond the $80 level. Way the options are priced right now, the market's expecting roughly about just under a $9 move. With coming at earnings, which kind of will coincide with what Dollar General did. So that's the trade to look at. Right now, that's set up for about $2.50 is kind of where it's priced in at. Just bumped a little bit there. So essentially what we're doing, that's the risk we're putting on the table. So we're spending $250, so $250 in other words for a single contract. And that's what we stand to lose if it doesn't go down.
Go the way.
Yeah. So if it doesn't go down, we're going to lose that. I mean, we've still got some time on our side till July, but if it does go down, then we're looking to potentially, as we do the rollovers, capture up to about the difference there, which is going to be $7.50 in profit. Will be on this trade.
Interesting trades, guys. Thanks for laying out the bull and the bear cases for Dollar Tree. Just a reminder to our viewers that this debate was for educational purposes, does not reflect our personal opinions about the stock. Now, before we move on, Jason, you're going to elaborate, I think, on multi-leg option trades.
Yeah, we've thrown out some really interesting terms, and we've thrown out some interesting trades, not just this week, but in all past weeks. So I wanted to take everybody through the option chain and how we can actually make those trades come to life. And it also gives me a nice opportunity to kind of highlight some of the other educational offerings that we have here to get people into the platform and using it with an expert level. So every week we run a masterclass on the Active Trader platform. We've got a 3-part series, one on getting started. Tomorrow's class is actually focused on how to getting the most out of from an options perspective. And the third class, which will come up next week, is all around charting and research. So lots of great stuff in there. So come join Brian tomorrow at I think it's 1 o'clock tomorrow.
1 o'clock, yeah.
And you're in good hands with him. You've seen him on the show here before. So
Brian Rogers, no stranger to the program.
Absolutely. So let's get in here. I'll show you how I'll walk you through how you can create the Iron Condor that I placed for everybody earlier. So we've got the DLTR chain up in front of us. I had selected the July 25th options expiration. Now, for me, I'm maybe a little old school this way. I like to choose my strike prices right from the chain itself, but I'm going to show us a creative way afterwards. So if we're thinking about doing the trade here, we can go ahead and start by, I always like to choose my dominant leg, the sell leg first. If I go ahead and click on the bid price, you're noticing my order ticket's starting to fill in below. But Iron Condor is a 4-legged trade. That's one of the key features of the platform. We can do up to 4 legs here all in one trade. So looking, if I wanted to go ahead and make this $10 wide, I'm going to add in the $75 puts. I'm going to buy those, but don't click on the asking price. That's going to start a new ticket. You can click on this little plus button that's right off to the left. You can see I now have my vertical spread is down below. Now, the nice thing about the Iron Condor, it's just 2 verticals like I mentioned earlier. We can go ahead and start adding in our trades. Once again, focusing on the little plus buttons next to the bid of the 105s that I want to sell, give that a click, and then down on the asking price next to the 115 calls that I want to buy. And there you have it. Even confirms the name of the strategy right in the order ticket. So I've got a nice reminder of what I'm doing. All right, now one other quick thing here. I want to go ahead and amend the option chain for everybody. That's the way I like to do it, but once again, no one-size-fits-all solutions in the platform. Looking towards the top left-hand corner of our option chain, you notice where it says spread single. Well, if we click here, you notice there's a lot of the most commonly used option strategies. Iron Condor happens to be at the bottom. What's really neat about this, it's now you can see within the strikes, it's actually created the Condor right in the platform. So I can do this order with just one click of a mouse. Now, mind you, I'm going to go ahead and shorten down the strikes because the strike width, just because when the trade I was doing is just 2 strikes wide. So we can now see my trade will be able to mimic here. It'll be this one right down here, the 85, 95, 105, 115. If I want to go ahead and sell this, all I'm going to do is click on the bid price, one click, there you have it. Our Condor is created. And for those that want to take this one step further, just quickly, you've got your Analyze tab right here. I've got the ability to click Analyze. I can go ahead and now I've got my risk profile generator. If I jump over to the Analyze section and look at my risk profile, it didn't pop over. Let me see why it didn't. Either way, you just go ahead and hit, let's get that up there again from the bottom. Click on Analyze. Plan positions now created. The joys of live TV, but in any case, in your platform, you'll now see the wings of your Condor there for you to analyze where your profit and loss is going to be maximized.
Right, some great tools there, old school and new school. Yeah, no how you want to play it. If there's a stock you at home want to see our debaters go head-to-head on, send your suggestions at td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website. If you can't join us live, be sure to visit our YouTube page where you can catch up on all the previous debates. And since those debates often happen before a company reports, you can actually keep score as well. Yeah. Could be a bit of fun there. The link is right there at the top. And don't forget to like and subscribe. All right, before we wrap up for the week, we got plenty coming up. I'm going to start just by saying I'm watching the BOC tomorrow. Bank of Canada has a rate decision. The Street's expectation, TD Securities' expectation is that they're on hold, particularly after that stronger than expected performance for the Canadian economy that we got on Friday from the GDP numbers. So that's what's happening here. What's happening in the rest of the world?
Yeah, so just to piggyback off of that, Greg, ECB, the European Union, they're also having their meeting on Thursday, so they're expected to do a 25 bips cut on their side. So we'll see what shakes out. But just domestically back here, we've got some macro data that's kind of of note for this week. ISM service PMI numbers are going to come out on Wednesday. So again, this is a measure that tracks the services sector, constitutes the majority of the U.S. economic activity. Forecast reading is to be around 52, up from April's 49.4. So usually how you want to interpret and understand this is essentially any reading above 50 indicates an expansion in the services sector. Anything below is obviously a contraction that we have there. So this is really the employment and the prices paid components are going to be critical parts of this. And also tell us a little bit about inflation, the inflation picture or pressures that are going to happen here. So that's one to keep an eye on. And the second one is non-farm payrolls, which is the big one on Friday, of course. Unemployment rate and average earnings are going to come out. Non-farm is expected to show about 180,000 jobs to be added, slightly up from April's 177,000, but it is below March's revised numbers of 185,000. Again, this is interesting because the Fed will look at this towards the neutral policy and just keep a close eye on this, the job numbers as well there. But on the equity side of the things, we are going to be looking at Broadcom. So they have their earnings coming out, kind of one of the final ones of the AI companies or semiconductors over here. Broadcom's gone through undergoing a strategic transformation, which they've really shifted from their strategic sort of hardware-centric model to a hybrid software subscription platform, and that was through the acquisition of VMware that they just had back in like the end of 2023. But coming into this Q2 on June 5th, when they released their earnings, revenues expect about $15 billion. That's 20% year over year. EPS is going to come about $1.57. Again, that's a 42.7 year over year increase. Big news that investors will want to keep an eye on is the AI revenue growth. Their custom chip projects, which they're known for. XPUs, I mentioned this like maybe many shows ago. Extreme processor units is what they do, and they customize it for their hyperscaler clients who boast, such as OpenAI, Apple, Meta is also in the mix as well there. So that's one to keep an eye on there for. Looking at the charts, though, what we do see is, like many of these companies, they've swung right from those lows. They've broken down through this channel breakout over here. What we are going towards is this resistance zone, which I had marked, which in fact they just broke through. Now, candle's still forming for today, but they have broken this 250 level. And this was, in fact, they've captured back at the highs of December what they had. So they are now firmly above those previous highs and positive for year to date, of course, by that same notion as well. Coming into this expected moves that are going to be coming into this marketplace, it's significant for a stock like this. Typically 10% is what it's going to be. So we could see an upshoot like pushing up to about the 270 level, but it could come down back to the near-term support if it does miss or the street doesn't like how they're guiding, down to that 220 level. One other thing I'm keeping an eye on is the gap at the 216 level. We could even see it push further down to close that out there. So Broadcom is the one to keep an eye on for Thursday.
All right, Jay, when it comes to your company, I never had nice penmanship to begin with, but when I have to sign something electronically, I'm like, they accept that chicken scratch as contractually binding, yeah. But they do, DocuSign.
They sure do, yeah. Viewers may or may not have heard about this company, but you're right. It's actually the industry leader in the e-signature space, which is hoping to allow more flexibility and actually easier management of contracts. So they've got earnings coming up on Thursday, and DocuSign's price has actually been on quite a run over the last 2 years, up almost 90%. And this is maybe proof that no business can escape the AI kind of influence, and DocuSign is no different. About a year ago, they released a new product called Intelligent Agreement Management, IAM, and it helps businesses create, manage, and actually gain insights throughout the whole life cycle of their agreements. So it'll be interesting to hear about that. But jumping into the chart, you can clearly see the big increase over the last two calendar years. More recently, we've seen some pretty positive results in terms of earnings and price action. They've seen some big gaps, and even what's important to hear that I want to show, the last earnings, yes, there's been a lot of fluctuation. That's been kind of the nature of the game in the economy lately, but they've recently been able to hold that gap up, and we've seen some prices. There's been a consolidation pattern that's happening over the last little bit. We've broken out top of that. We're looking to see if we can crest kind of over the recent support that we've seen, that we've got marked on the chart. And the last thing to note, coming to earnings, the company has a very small to little moat. So I want to be listening for client retention numbers coming in. As the company grows, as they come into much bigger direct competition with software as a service companies in that landscape. So they'll be listening here how that's framed by the company.
All right, plenty of things to keep our eye on. It's also the month of June now. That might not be a news flash, but maybe you didn't know that this is the first week of Options Education Month for us. What resources, workshops we got available this week?
Yeah, we've got lots coming. Options Education Month is kind of one of our flagship offerings. We've got over 50 hours of master classes. A couple of ones I'm going to highlight for Kieran and I. We've got coming up starting tomorrow. We've actually going to be highlighting more of the Active Trader platform, where we're going to be taking the life cycle, taking a look, in-depth, hands-on approach to the platform, but also helping clients look for ideas and identify and how to enter, manage, and place trades on the platform. And then we're going to pick this up as a weekly series that's coming up every Tuesday and Thursday. You'll see us here, and there's lots of other
every
opportunities.
afternoon. You can join us. We also have our Inside Investing show, Greg. So we bring industry experts into it. So this Thursday we're going to have Richard Ho from the MX, or actually BMO ETFs, I should say, where they're going to be talking about the debate of whether to trade options or hold options ETFs there. So just going through the pros and cons and which makes sense for different viewers. But just on the other side, like Jay mentioned, besides the workshop that we're going to be taking, we also started a new workshop called Trading Options in Small Accounts there. So in a lot of new investors, trepidation and how much they should allocate capital. So this class is really going to lean into how much capital to allocate, proper risk management, kind of different sort of equities you want to pick as you start your options journey there. So tune in for that. That's in fact tomorrow, and you can check that out on our website that we have.
Lots of great content. We're just getting started on Options Education Month. Unfortunately, though, we've run out of time for the show. Thanks again for another great one, and I guess we'll get together again next Tuesday.
You got it.
You got it.
All right, that's it for our show this week. As always, investors should perform their own due diligence before trading. Thanks for watching.